The government's just going to give me free money. Well, how much do you make? I make 100 grand a year. You don't qualify. I thought I was your only lender. That's what you told me before.
So sometimes you gotta, you gotta have a plan B, okay?
Okay.
Well, you fast. So
Don't tell anybody else that. 3, 2, 1, go.
Okay, so today we have Tyler Bahnsen from the Homebridge Loans.
Homebridge Financial.
Homebridge Financial. So he's one of my preferred lenders who've been for a very long time in the business. And today we're going to do some myth or reality. So we're going to break some myth and just cover some basic through the mortgage industry and what people believe in. And sometimes they're wrong.
I thought I was your only lender. That's what you told me before. Is that a myth? Or is that a reality? What is that?
I think it may be a myth, but you're my favorite.
Sorry to hear that. That's good to know.
Well, hey, so sometimes you gotta, you gotta have a plan B, okay?
Okay.
So tell me a little bit about yourself. How long you been in the industry?
I've been in the industry since 1949. I was one of the first people to ever do a mortgage. Outside of that, we've been doing this at a good clip or a high capacity since 2009. What's so funny?
I'm just trying to do the math.
Right? But no, I've been at this a while. We've kind of gone into business for the most part, like I said, since 2009. So we have a little bit of experience during the ups and downs and everything else. But we built a business simply on being the most responsive, as you might know, right?
Yep.
And that's kind of how we organically built our business. We've been growing about 20% a clip since 2009. And like I said, we're the fastest to respond, the most reliable, and as far as I'm concerned, the most knowledgeable.
And you're a direct lender.
We're a direct lender. And that's a misconception, too, with a lot of consumers these days, because back in the day, in the 2007, 2008 era, everybody was brokers. Most people in my position started working for direct lenders or became direct lenders at the end of the day. So,
okay, well, let's get it started. So today we have 20 myth or reality questions.
That's a lot.
I know.
You didn't have to bring that up. That number sounds big, but go ahead.
Well, you fast.
Let's start.
So
don't tell anybody else that.
The first one is, of course, that a lot of people say, hey, I'm not buying the house because I need 20% to buy a home.
Sure. Definitely a myth, a misconception. I still, believe it or not, get that a lot. Whether it's a conventional loan or any type of transaction. A lot of people or consumers or clients or even realtors might assume that you would need 20% down, but there's numerous options outside of that scenario. I mean, you could do 3% down as a first-time home buyer. Not only 3% down, you can combine that with potentially down payment assistance. So there are other options outside of 20% down. There's a ton of stuff. I could go on and on about the different types of loans. 3%, 5%, 10%. There's numerous options outside of 20% down for sure.
So, and what is the least down payment you can do?
Well, if you're a veteran, you can do 100% financing. And like I had said before, you could do as little as 3% down as a first-time home buyer, conventional loan, potentially with some down payment assistance where you would need no money out of pocket either. So there are other options. But veterans, the least amount down, 100% financing. First-time home buyers, as little as 3% down. If you're not a first-time home buyer, as little as 5% down. Investors right now, you're probably going to be dealing with 20% down straight across the board with the current lending environment, the way the economics are, but you might be able to do 15% down as an investor as well.
Perfect. So, and then talking about that, let's jump to another question since we're talking about down payment. Mm-hmm. A lot of people also, there's another, you tell me myth or reality, it's that if you buy in a condo, specifically not a single family home, that you have to have 20 to 25%.
Yeah, that's the most prevalent nowadays, especially with what, happened, unfortunately, in Surfside. And there's just always been a misconception that, for example, if a condominium doesn't have sufficient reserves within their budget or their financials or something else is going on therein, you have a lot of listing agents that have listings that say, oh, cash only, or you need 25% down, or you need more money down. They're just not in the know, so to speak. They don't realize that there are other options if there's issues with the condo. And the biggest thing with condos and the down payment, of course, as we probably know, is budgets. Do they have sufficient reserves? That's 95% of the battle. If they do, great. We revert back to the lowest down payment scenarios, 3, 5, whatever the case may be. If they don't have reserves, you can get a little creative with a piggyback second mortgage. What does that look like? You do a 75% loan to value first, The remainder is a piggyback second that kind of works like an equity line of credit. So there are other options outside of that. Not only the reserves being a big thing, but now the assessments for structural work, passing the 30, 40, or 50-year certifications has become a big issue, and it's going to continue to get more difficult. Are there ways around that? Not really for traditional financing, but we do have options in the private sector for stuff to where, somebody didn't pass an association or a building didn't pass the 50-year, they're doing work on the structure of the garage. That doesn't sound good, right? Well, we do have options outside of that.
So when you're saying, like the certification, like, are you looking, is it the building only becoming problematic if they going through that certification, or they're about to be due, or they're like almost finished and we don't know if they actually going to pass it? That's
actually a great technical question, and it's a good one. So we only start having concerns in the event that they didn't pass.
Okay. So if they're going through
if they're preparing to pass and there's no violations and it's nothing over dramatic, like they've been flagged but didn't have a violation for severe structural issues, then a lot of times we can get around those things.
So as long as it's scheduled, association, like
as long as they're taking preventative measures prior to that inspection happening and failing, there's good possibility that we'd be okay.
And so talk to me how you guys find out about those issues. So because like we all know that 20 and 25% difference as a realtors, right? It's a questionnaire. So the questionnaire sometimes comes with some little thing of like, I had one time, I couldn't close with 20% because the boat dock was leased for a few units from a third party. It did not belong to HOA.
Lease.
And literally, like my famous Rocket Mortgage just dumped us on the last day of closing, and we were not able to close. So we had to find a different lender to close this transaction, to start with a limited questionnaire from the beginning.
Yeah.
So talk to me about the limited questionnaire, full review.
There's a lot going on there, and it's another thing that's a great question. I mean, and it kind of parlays into the numerous scenarios if a condo is financeable or not, such as, do they have reserves? Is there litigation? Are there assessments? Did they not pass the 30, 40, or 50-year inspections with the city or county or whatever? So it's complicated. There's just numerous ways this could go. What was the question again?
So the question was like, what's the difference in between, like a partial, like how do you know when do you, sometimes you have to do 25% to do the partial?
Great. Yeah, I can't speak on other lenders, but if you want to talk about true traditional conventional financing with Fannie Mae and Freddie Mac, condo questionnaire actually isn't required ever. So there's just a few questions that need to be answered, and it's considered a full condo review. If the association answers those questions via email or verbally, we'll do a certification and sign off and move on.
So it's different lender to lender.
That is correct. Most lenders are going to request that actual document that's, somebody working at the association or at the front desk of a property management company is going to puke, right? They're like, oh, this is going to take forever. It's $500 to fill it out. Oh, my God, the world's going to end. So just a few tidbits on a full review. We're going to ask questions first with the association. We're going to say, hey, is there any litigation? Do you have any ongoing assessments? If you have assessments going on, for what? Structural? Did you not pass something? What's going on? Does one entity own more than 20 or 25% of the development? And I don't remember what else is the reality of it. And we're going to look at the budget too.
How many investors? How many?
That actually only matters if somebody's buying as investment. That's another myth, because a lot of clients, individuals, realtors, or consumers, whatever, they think that if the development has a tremendous amount of tenants, aka more than 50%, that you have an issue getting financing full, limited, or whatever the case may be. It's not a reality. If somebody's going to occupy the property, the tenant to owner occupancy ratio doesn't matter. It could be 95% tenant occupied. Now, if somebody's buying for investment, it's got to be under that 50% threshold. With that, we go by what the appraiser says. And I think we might know the appraiser's probably not going to do their homework, and they're going to put whatever the heck that they think might be a realistic figure. And that's the thing, we don't walk necessarily a severely fine line or live in a gray area or anything like that, but there's things that are allowed and things that aren't allowed, and we abide by what's actually allowed, which meaning you don't need a condo questionnaire ever. Now, 50% of the time, the association answers the questions, or we call them, butter them up, then they answer the questions appropriately. Sometimes they won't. we're not going to answer your 5 stupid questions. Give us $500 for a kind of question, and then we have to go down that road. So,
well, everyone wants to justify their time.
Yeah, no, I mean, I get it. And that's really just, a lot of property management companies and associations just have a standard, protocol for stuff like that. And we get it. And we try to avoid that as much as we possibly can because those things just take too much time. I mean, we're severely into following up with associations and our management companies or whatnot on a daily basis, sometimes twice a day, just to move through the condo piece because most lenders can't, aka Rocket Mortgage. Being somebody in Detroit, with a headset on or a telemarketer or whatever division they have there to chase down an association in South Florida.
It's pretty hard.
Yeah, right. It's just not going to happen.
We can't find them in person.
You as a realtor are going to have to do that work, really, at the end of the day, if you're dealing with Rocket Mortgage or the bigger lenders, because they're just not going to attack the association like we would on the lending side. And that's not time best served for you now, is it?
And they don't have any time, like they don't have a deadline, right? They don't have anything. They have to deliver the questionnaire by, or the answer to those questions.
Who? The lender? Or?
The HOA, like when you send it to them.
They really don't. I mean, it's just, whenever they feel like it. They have turn times a lot of times where they're like, hey, pay for a rush for an extra 150. You get it in 5 days. If not, it's going to take 3 weeks. So it just depends on the association itself.
Okay.
But the biggest thing in lending is always condos. That's the most cumbersome scenario out of all of them. That's why we brought you guys the condo presentation when we did.
Well, and I think that's where, like you coming for me, that's the strongest play for you. It's like, give me the complicated condo and I'll get it done.
Yeah. I mean, at the end of the day, you just have to follow up and be aggressive with what you're doing. And that's not only with the condo world, that's with anything when it comes to lending. People drag their ass. They drag their feet.
That's why you're great.
Yeah, right.
So let's do the question number 4. So the myth or reality again, it's that I can only buy a house if I have 2 years of tax return. I feel like the most classic one.
It is. I mean, it's right up there with the condo piece and the questions about condos and down payments and this, that, and the other. It's not a reality. It's totally a myth. And even when you're self-employed. So, a lot of clients, let's say they're just a standard W-2 wage earner, salary, whatever, and they're changing their job tomorrow because they're getting, whatever, a higher salary. A lot of these people think or have been told by their friends, family, or potentially another lender, oh, you just changed jobs? Mm-hmm. You can't get a loan. Not true at all. As long as they're full-time and there isn't a huge long gap of employment to where they've been out of work 6 months and they decide to work again, if they're really rolling over from one job to the next and it's a full-time salary job, they could start tomorrow or they could even start 2 months after we close and we'll do a post-closing check-in and get a paycheck. So if somebody has a job offer that's explicit and we follow up with the company saying, their start date's April 1st, April Fools, and this is their salary, this is the reality of their job, we'll use that to qualify.
So, but that's only if they've been working in the same industry for like
No, so. That's another misconception and a myth. It doesn't have to be the same industry. As long as it makes sense, as long as they're full-time, guaranteed salary, whatever the case may be, we'll go with that.
So even if somebody was, let's say, a journalist and then became a doctor?
Well, that's okay.
Yeah. Okay.
I have nothing against doctors or journalists. But no, that's a big misconception. It really is. And again, back to the reality of, do I have to have employment or tax returns for 2 years? As a W-2 wage earner or salaried wage earner, absolutely not. The 2-year thing is, for example, if you're going to school and you just got a job last week, we're fine. Or like I said, if you're changing even professions, and as long as the new profession is W-2 salary, full-time, you're fine. Even if you're not going to start a new job that you got a job offer on, we'll accept the job offer letter for qualifying purposes, and we'll use that income. Self-employed, whole different thing, right? Generally, you have to have a 2-year history. Sometimes you don't. For example, let's say, I don't know a great example, but let's say you've been self-employed, or let's say you were 1099'd as a truck driver, and you'd work for a company for 3 years as a 1099 truck driver. And then all of a sudden you decided to start your own trucking business a year ago. In reality, we could probably get away with 1 year of tax returns for you.
Because the same industry.
There's a good chance. Mm-hmm. All we would need in that scenario is like, do you have a license that you could show us that you've had for 5 years? Or could your accountant tell us that you've been in the same line of work self-employed for 5 years? in that arena, we could probably get away with 1 year of tax returns. In that scenario, you have to have better credit, reserves, this, that, and the other. In addition to that, we also have, what we used to call subprime loan products or alt-doc products, like a 1099 loan or a bank statement loan. With those types of loans, you only have to be self-employed for 12 months. You don't even have to have a history of self-employed in the same line of work or anything. We can take your 1099 from 2022 and qualify you. We can take your last 12 months bank statements and qualify you, as long as we can document you've been self-employed for 12 months. So there are other options, even a P&L. We'll have your accountant draft a P&L. We'll look at your last 2 months business bank statements to make sure it's in line. You qualify. You've only been self-employed 12 months? Okay, cool.
So, and that's something which is, defer you from the big banks, because, for example, I had this client who been, who managed pretty much like 20 plus emergency rooms, and he been very well paid, W-2, but now he just, he went on his own. He started 1099, and he went to like Chase and Bank of America, and they said, hey, you need to wait till November, because that's going to be when it's going to be 2 years of 1099.
Yeah.
So that's pretty much, that's where you as a lender have strengths.
Yeah, that was about 20% of our volume the last 2 years when things have been severely busy, was alternative doc loans that big banks can't do. Rocket can't do those loans. Everybody knows Rocket, right? Bank of America, Wells Fargo, any of the big box lenders can't do loans like that. It's helped a lot, and at the end of the day, being self-employed is a nice benefit because you can avoid Uncle Sam at times, right?
Postpone.
There's
Let's put it this
there's
way.
a reason that you do that, for obvious reasons. So there's loans that are available. You're dealing with a little bit higher in rate, a little bit higher in down payment, but you pay your income taxes or you get a higher interest rate. Which one do you want?
And well, talking about taxes. So, I lost the question. Well, anyways,
Taxes,
forget about it. Lost it.
income taxes. Do you pay your income taxes?
Yeah.
Okay, good. Just making sure.
Yeah. No,
You wouldn't need one of those alternative doc loans?
Well, we'll see. But no, I put myself on the
fucking around,
payroll.
whatever.
So I am moving to the payroll. But anyways, so question number 5. That's probably, I don't know if you hear that a lot. I know you were dealing with some of my people who are not a permanent resident. So if you're not a permanent resident, a lot of people think they cannot buy a home. Finance the home.
Sure. I mean, that goes a few ways, whether you have socials or an ITIN number or whatever the case may be. But in reality, what we're talking about, I'm assuming, is foreign national transactions,
Correct.
right? Somebody's a citizen in another country,
Came here
doesn't
as a
have their parents
tourist,
here.
fell in love with a condo or a house, or did not even come here and planning to arrive. So what's their options?
So when we're talking about a true foreign national loan product, you're talking about somebody who doesn't intend to be here and live here full time, okay? That's the reality of it. And that's kind of how you have to look at it as the consumer and or as a lender and realtor at the end of the day. There's different options. Options are limited for certain parts of the world compared to others. But there are options. Foreign national loans, especially in South Florida, are quite popular. It's not that big of a deal. We're rolling out a loan product with foreign nationals that's actually as little as 25% down with fantastic rates, in the sixes on a 3, 5, or 7-1 ARM. Yeah, we're rolling out in about a week. It's pretty cool.
Sixes.
Yeah, in the sixes. It's crazy.
Sixes.
Yeah, with this type of loan
Where
product.
we have a regular rates right now, like in sixes.
Exactly. I mean, this is going to be on an ARM. It's going to be on a 3, 5, or 7-1 ARM, but whatever. Those are fixed for those terms, 3, 5, 7 years, and you figure it out after the fact, I guess. That's a newer product that we're going to be rolling a week or two. Unfortunately, it's only specific to certain parts of the world and certain citizens. You can imagine the ones that wouldn't fit that category. Unfortunately, there's certain investors that will invest in these assets that just aren't real comfortable with certain economic unrest in other parts of the world. But most of the globe will fit that product. It's really cool too. Most of these investors, these foreign nationals, they're usually self-employed. So all we're going to want is a letter from their accountant from Italy
From their country.
or wherever they're from, stating their income over the last couple of years, and that's it.
That's pretty cool.
They're going to have to move some money over to the U.S. for the down payment and everything, but that's really the biggest part of it at all.
And that's for them. It's only partial occupancy or like straight investment.
It's really a straight investment or a second home. You you can't take this as a primary residence because then it's not a foreign national loan. That's where a lot of those deals go a little wrong because, these people want to move here and start a new life here. And, we have to have some sort of documented income from their country, which is pretty easy. It's a CPA letter, right? Tell me their income, Mr. and Mrs. CPA, accountant, whatever you want to call them. And we'll accept that with 25% down. It's a new product. It's something that we've been searching, with our investor pool for a long, long time. And we're really excited about it. For countries, it is super strong. Yeah, it's super strong. For countries that you might assume might not fit that box, you're looking at a lot lesser terms, at least for now. I mean, this conversation's February 6th, so anything that I say today could change tomorrow. That's the reality of lending and the environment that we're in. But for countries that don't fit that box, then you're looking at a larger down payment, 35% down if they can document investor experience in their country or
Which
here,
is still great,
or 40% down if they can't document investment experience. But that rate ticks up to about 10%,
which is the norm right now.
It's like a hard money loan at the end of the day.
But if right now you go to a regular bank and you do the foreign national, you're going to be in nines.
Yeah, and regular banks won't do it unless you're talking about the banks that are truly foreign banks that are here, on U.S. soil.
And let's be real, for the foreigners, 9 or 10, that's typically norm in their countries.
Yeah.
So it's not like.
But that new product we're rolling out, it's pretty sick. It's a great product. We're excited about it. We were never really big into the foreign national deals, but we're going to market the heck out of that because it's really competitive compared to what's out there.
True that. I want to know all about it. Yeah. Okay, so let's go to question number 7. I think that's going to be the fast one. We covered a lot. It's that a lot of first-time home buyers who call me, they say, hey, we automatically can get a down payment assistance.
Mm-hmm.
Is it true? Is it not? What dictates if you qualify for down payment assistance?
Good question. I mean, there's a plethora of down payment assistance available in Florida and across the U.S. The biggest one, that just rolled out nationally, I forget the name of it, but it's, you have income limits. So you've got to be able to look at the guidelines for all these types of scenarios. The most popular, at least in Florida, is Hometown Heroes. You might have heard of that. Yep. For nurses or doctors or firefighters, first responders, whatever. That's a great program where you can get actually 5% of the loan amount to put towards your down payment and or closing cost. There's a lot of money left still. DeSantis approved $100 million. Who knows if they're going to extend that or not? But there's still a lot of money left for that program, and we've done a lot of those. But there's down payment assistance, bond programs. I mean, there's all sorts of things. We're willing to work with any of them on a county or state level, nationwide. We just have to kind of work through their paperwork and get signed up with them and whatnot. But we're willing to work with any of them. But yeah, it is a bit of a myth because first-time home buyers are like, so what do I get from my first-time home buyer? I don't need any money, or the government's just going to give me free money. Well, how much do you make? I make $100,000 a year. You don't qualify.
What's a limit typically?
It depends. So, I could misspeak a little bit. For example, Hometown Heroes, I think that you can't be over 130 or 140 grand a year or something like that. Mm-hmm. A lot of the other down payment assistance programs are a lot lower in terms of that income threshold, because if you make a certain amount of money, why do you need down payment assistance, right? So it's case by case. Credit score requirements come into play at times as well, like it does for Hometown Heroes. Income limits are big. So, it's a bit of a myth, but there are things out there. And more as this, market kind of settles down, the majority of our market, for the next couple of years is going to be first-time home buyers. So this is a question that's going to continue coming up. And we've made sure that we have, the knowledge about down payment assistance and the availability of funds for clients. Listen, I'm all for it. It's just, in the past, it's been very few and far between. Now it's becoming actually a pretty important thing to be educated on.
Well, I never done down payment assistance, so that's something.
Yeah,
I was always kind of wondering how it works.
Yeah,
never market myself towards that, and I never had a person asking for it.
Yeah, so. Our secondary department and our we have an affordability entity of HomeBridge. So in the past we'd be like, oh, we're not signed up with them, we can't really go down that road. Now we're willing to work with any of them. So.
Well, talking about, you touched the credit score. So another, I think, myth or reality, right, is that a lot of people say, hey, like my credit score is 600. I will definitely not qualify.
You're right. You won't. Next question.
What's a minimum?
So it depends. So,
In London, it's always it depends.
if we're talking about straight across the board stuff, which we're talking about, 97% of the U.S., looking at conventional or FHA loans or whatever, right? If we're talking about traditional, conventional conforming financing, a 580 will fly with FHA if you're a sole borrower, 620 with conventional. The cool thing that happened recently with conventional conforming financing, Fannie Mae, Freddie Mac, whoever you want to call them, they actually have allowed a blended credit score now.
I was about to ask it because I remember from your presentation.
It's super cool. Yeah, it was been about a year or so. So now, for example, you could have, a younger person who's got, relatively newer credit, or maybe was late on a credit card in college, whatever the case may be. They have a 540 credit score. But mom, she's got a 780. We throw them together, there's a very good chance that we're going to get what's called a DU or an LP approval, Fannie Mae, Freddie Mac approval. It's pretty cool. They blend the scores to blend the credit profile. So it's a whole different thing now. FHA, you still got to be at a 580 or whatnot, but conventional loans, you can actually blend the credit profile to see if you qualify. So there's really no minimum if there's another borrower on that loan.
But if there is another borrower, does it also comes with their debt to the equation? Or
it does. It does.
So it's all the income and debt, everything, like the full profile.
Yeah, it's just not that simple. You're right. You still have to qualify with debt or the income, whatever the case may be. If you're buying a $300,000 property and mom's got the great credit but no income and she's got a couple debts, then you probably have an issue, right?
Oh, you need that.
Yeah. So, but usually people with really good credit, you'd be surprised. They help with qualifying regardless.
Well, talking about that, actually, we did have another question which we kind of crossed out, but let's jump into it because a lot of people do think that if they co-sign on a friend's car purchase, let's say, then it will not affect their buying power down the road. Like it's not going to affect that part on their credit profile when they want to buy a home.
Whoever it is you're co-signing for, if you're co-signing for family, whatever the case may be, and they're right for the first 12 months. Okay, so if you co-signed for your brother or sister or whatever on a car and 6 months later you want to buy a property, we have to hold that debt against your debt to income ratios. Now in 13 months, you want to go buy a property and your brother or sister, whoever, can provide you 12 months business banks or 12 months bank statements that they've been paying that debt, then you don't have to hold it against you. It's like it's not there.
So pretty much do not co-sign if you want to buy a home in the next 12 months.
Yeah, I mean, I definitely, avoid it unless you're obviously going to qualify with whatever the potential payment is. There was an interesting scenario that we have now where mom is owning an investment property for a couple of years. She's been making the mortgage payment for a couple of years. We're adding the daughter to the loan to co-sign to qualify. And the daughter's like, well, is this going to be a problem for me when I go buy a property in 6 months? No, it's not, because the mom's been paying the last 2 years. Yeah, there's going to be a lapse in the servicing, so there'll be about a month where there's no payment. But we can document that the mom's been paying it since inception, and she'll make the first payment, and moving forward, she'll be the one making the payment. So in that particular instance, it was a great question, just a little more complicated, because she's not on that debt for 12 months. She just co-signed yesterday, closed, today, and there's not going to be 12 months going forward with her on the note. But because mom was on the original note with a prior lender, and we can document that, it's fine as well.
Very creative.
Yeah, it's just the reality. That doesn't come up very often, but it's another good example when it comes to those things. I mean, co-signing at the end of the day is exactly that, or authorized user,
Because I think that's when the whole misconception comes. You feel like a co-signer, you don't take, like, you just helping, but you're not taking all the...
Yeah, a lot of people think that or they're told that it doesn't show up on their credit, but 99% of the time it does.
Yeah. I co-signed on my friend's Tesla, and and Wells Fargo just keeps sending me all the kind of statement and things. Nice. And my credit got like I see it there. So and I was like, okay, I guess I learned it that you co-sign it, it is on your credit.
Yeah, and don't buy anything after you get it pre-approved for a mortgage. This seems to be coming up quite a bit. Which
Say it again.
You never thought that it would, or people would realize that you probably shouldn't go on vacation and open up a couple credit cards and get a car.
Don't buy timeshare in Mexico.
Yeah, it's one of those things.
Don't buy furniture on a
used
credit.
to never come up, and when realtors would tell me, oh, well, I'll make sure that they don't buy anything, and I'm like, obviously. Well, it's coming up again for people who like are ultra successful too. Like I've had people that midstream, go on vacation and they racked up some credit cards and they do really, really well. Great salaries. They had some debt or whatnot, but all of a sudden, oh, I forgot to tell you, this was a Tesla. My Tesla came in. I didn't think it would come in so soon. My payment's $1,200 a month. Oh, we took a trip to South America. We opened up a few credit cards, and you're like, what? Mm-hmm. What are you doing? What's more important?
I had one of my buyers who, we had a conversation of, nothing, you shouldn't be buying anything. And then the lender calls me and he says, Yulia, we're going to need, to have an extra week. And I said, what's going on? And he said, well, she just purchased a car and she transferred $20,000 from her UK account to buy this car.
Nice.
And I was like, awesome. Whoa, okay. And then I called her and I said, what's going on? And she said, well, my lease was up. So I had no choice. And I was like, how about rent a car for a month?
Listen, I can't blame consumers for doing things like that because they just don't know any better. So it's on us to kind of set those expectations. We used to send out, at time of pre-approval, we used to send out a flyer too, where it's like do's and don'ts, top 10 do's and don'ts after being pre-approved. Don't buy a car. Don't buy another house.
True that.
Don't get new credit cards. And then we kind of like let it go by the wayside because we never had those problems until recently again. So
back to the basics.
Yeah.
Okay, so I think we somewhere in question number 10. And as a one, I meet this one a lot. It's when people are self-employed and they're making like over 200K, which is decent income. And they believe that they're going to be easily qualified, so they don't even want to do the pre-approvals because they're like, hey, we have all this money in the bank, we have money coming in, we're making good 6 figures. What's the reality on that?
This is where I say, rocket. I say rocket mortgage because
they're going to say, you can afford $2 million house.
let me get on my phone and do a quick pre-approval application for rocket. I'm self-employed. $1 million a year. Pre-approved. Sweet. Have a nice day. Here's my pre-approval letter to a realtor who's going to drive around God's creation for the next 6 months with somebody that actually doesn't qualify because they didn't look at their tax returns. So the thing about that is it's as a realtor, you really just, that's why you have to have a lending partner, so you trust them. As a realtor, you can't trust what a client's telling you. The old saying goes, buyers are liars, right? Well, they just don't know any better. They may not be liars, but they just don't know. They think they make $200,000 a year, and their tax returns show negative $150 because of all the expenses and not paying Uncle Sam, right? So it's a thing to where be careful, know your client a little better, regardless of the car they drive when you're showing them property, and make sure that they're qualified by a team that knows what they're doing and they cross every T and dot every I. Because, like I said, and it doesn't make me look amazing for throwing Rocket Mortgage or Bank of America under the bus, but the reality of it is just that. I've had plenty of clients that I've spoke to or my team spoke to where they're like, yeah, but I got pre-approved by such and such lender or bank for $500,000. You said I only qualify for $250,000. I was like, did they look at your tax returns?
That's what I asked.
Did they look at your pay stubs? Did they realize that you only have had overtime or commissions for 6 months? Or did they ask you any of these questions? No. Let me ask you this. They pre-approved you for $500,000. Do you know what your payment is on that? No. Okay. Are you okay with $4,000 a month? No. So these questions come up a lot, and we've learned our lesson. Listen, we're still not perfect, and we haven't been perfect over the years, and have grown from certain things. But we're always severely clear with the client. Hey, Marie or Bob, you qualify for $1 million. But are you okay with that payment? No. So let's not approve you for $1 million. Let's approve you for $600,000 because you're comfortable with that payment, or whatever the case may be. So we're always very clear over the phone, and we always, double that and put it in an email so nobody can say, oh, I had no idea what my payment is, and they have sticker shock once they're under contract. So we're always very, very clear. And we always do our full due diligence with any clients, whether they love us or hate us, before we're going to issue a pre-approval letter. We've even gotten more strict as of late, too, where we're requesting more docs up front, because we want clients to have some skin in the game, meaning just send me a pay stub and a W-2, and how about your driver's license and a bank statement? Is that going to be so tough? Even if you know that they qualify, and in some circumstances, if somebody's got to make an offer really, really quickly, we're not going to request docs up front. We'll just, get them trailing after the fact, or if it's obvious, it's obvious. But we've noticed that once clients are under contract, it takes them 2 weeks to get us everything. So now we're just requesting everything up front, number one, to know that this client's responsive so we can close on time. And if they're not, and 2 weeks goes by and they don't even send us a paycheck prior to getting pre-approved, we know who we're dealing with once they're under contract. So.
Well, and the chances if they did not send you anything that they not as motivated as well.
They're not as motivated, or they're just, a bit complacent, or, listen, myself personally, in my personal life, trust me, I'm the biggest procrastinator on the planet. So again, I can't blame people, but at the end of the day, we can't look bad in the eyes of our clients, such as you as the realtor. When somebody's under contract, you're like, hey, where's the loan commitment? Well, we still need their bank statements. I know it's difficult to download those, but we're still waiting on those. So we've started to really dive into more documentation prior to pre-approving clients, just so they buy in at the end of the day, to make sure we're dealing with somebody who's going to communicate.
Well, tell me advice for, for people who listen right now. So when people don't have the preferred lender, right, and they looking for one, what would be your first recommendation? Like the main one?
Meaning if they're asking you?
If they're not asking me, if they're asking me, I can tell them who to go to. But let's say somebody's sitting somewhere, I don't know, in Texas, and they're like, I want to buy a house. Mm-hmm. How do they look for a lender? Like, what would be the number one, not to go to those online companies and make them believe that they're approved for $1 million and their payment is only $3,000, and they go and start falling in love with the houses, and then they can't afford it.
People fill out the Rocket app, or they go to Bank of America because they've had their checking and savings account with them for 30 years, and they think that they're going to do them a favor. Instead, they're just another fly on the wall, right? I really think that the best person to ask is your realtor. Secondarily, family, at the end of the day.
How would you understand that some of the online companies are just not good and can fail you?
Yeah, it's a slippery slope. It's really difficult to be in a position as a realtor and, portray the reality of the pitfalls of working with these types of companies. I mean, Rocket's an easy one because you can just go online and look at the reviews and see all the issues there.
I don't work with them. I mean, I'm sorry, Rocket, but I had them dropping me on a closing day, and I saved the deal, but I learned a lesson.
It's one of those things. I mean, it's not easy, referring partners with anything in life at the end of the day. Like, if you need your cabinets redone and the guy doesn't show up, or girl doesn't show up for days on end, whose fault is it? Yours, right? So it's not an easy thing, but it's just really the conversation. Listen, here's my experiences that I've had with other lenders, or this lender or that lender, and that's who you're pre-approved by. Not a bad idea to get a second opinion. Maybe talk to somebody else. Maybe they'll give you more insight. Maybe they'll give you a better deal, a better rate, whatever the case may be. And the easiest response is just get a couple opinions. Don't just rely on one. I don't care if it's your brothers, sisters, moms, dads, whatever the case may be. It's always good to have a second opinion because you just never really know.
Yeah, and if they differ completely, like by 30-40%, then you probably know that one of them is off.
Yeah. then they wallow in it, and we clean it up if we have to after the fact.
That's what you're good at. Okay, so let's go to the next one. I think this one is also very famous for South Florida, since we have a lot of new developments. And, new developments, they push in their in-house lenders. Mm-hmm. So do you have to use the in-house lenders when you're buying a new construction?
No, you don't. And that's another thing too, is the Lennars of the world, they have their own mortgage company and whatnot. And believe it or not, a lot of times, maybe not the case now because of the economics of lending and fighting for every deal necessary due to, the current real estate market. But synonymously, these builders either have joint ventures with lenders or even own mortgage companies or mortgage lending institutions, and they're building, any of these benefits that they're stating that they're giving these clients. Hey, we're going to give you a 20 grand closing cost. Well, they got to make it back somewhere. Margins are really, really, really slim when it comes to builders. They're not making a tremendous amount of money. They got to turn these properties over very, very quickly because their margins are really, really slim. So they had the bright idea to start companies or doing joint ventures with lenders, making people assume that they're getting an amazing deal if they work with their direct lender, when in fact they might not be. Most of the times when I've seen loan estimates for these builder lenders or whatnot, they're priced a lot higher because they've got to make that money back somewhere at the end of the day.
And they make it scary also for you to think that you can actually use your lender. That's an experience which I had. And I was like, no, nobody can tell you which lender you have to use. You can use whatever lender you want. But I felt like the new development so trying to push it that people really think that they can't.
Yeah. Another slippery slope and what can be said and what can't be said. I think, and I could be quasi wrong, from a seller's perspective, I think that if it's in the contract, they can almost do whatever they want. Not whatever they want, and you can't really play the game of pushing lending on people. But I think if it's in the contract, if you work with Lennar, we'll give you a 6% seller credit towards closing cost, then I'm pretty sure that they can do it. I mean, it's borderline suspect, but I think it's the seller's way or the highway at the end of the day. And if a buyer signs a contract stating such, then it is what it is. But we used to be in contracts all the time back in the day, where, they had to use our services and we'd also give them a credit towards closing cost. We had a joint venture with a large servicing company prior to my days with Homebridge to where, we had free reign of listings, and we told the listing agents that, listen, if they use us, we're going to give them a credit towards closing cost. I mean, how many times are people just going to not even question it and just work with us, right?
Are you still doing that?
It's a shtick. No, we're not. This is in the day and age where we had, again, my company before, Homebridge, where we had a joint venture with a large servicing company with a lot of bad debt, meaning assets, meaning foreclosures. So we were facilitating those to agents all over Florida. And to keep those loans, instead of, getting scratched and dent and beat up on the loss that was a foreclosure, we tried to recoup some of those funds by getting those new buyers back in-house so we could gain the servicing of those deals and not lose so much like we did on the foreclosures. It's a great thing for somebody like me. It's part of the reason that I built my business. But that kind of is the same thing, in building, especially now as a builder. You've got to find ways to make money. And you're going to do anything creatively that you possibly can to kind of increase those margins, because they're even worse now than they were over the last 2 years, obviously.
They're still pretty good compared to, again, other places.
What do you mean?
Like, the different states where you build in.
Oh, well, sure. No, of course. It all depends. Sure, it's state by state, builder by builder, product by product. But it's a good question. Is a buyer ever required to work with a builder's lender or a subdivision's lender or whatnot? No. But if they sign on the dotted line that they have to if they want a credit, then it is what it is. Just be careful with those types of scenarios, because maybe you're getting a super high price in terms of your rate and cost compared to if you were to go to somebody else. Maybe it's not worth the $5,000 towards your closing cost, $10,000 towards your closing cost, long term. That's why you always get a second opinion. No matter what.
Okay, let's move on to the next one. I think it's my favorite because I have it a lot right now. So I am a Russian citizen and I cannot get a mortgage right now in U.S.
Yeah, that's what I alluded to earlier. The certain countries that are a little difficult to get financing for. The investor pool is very slim for stuff like that. You can. But, 35% down, like I said, if you have investor experience that you can document in your country or potentially even in the U.S., or 40% down if you don't, and rates are around 10%. That's Russia, Ukraine, Venezuela, and Turkey right now. Those are on that list, the exclusionary list.
Is there?
Economics. Mm-hmm. They have some severe economic issues right now. Yeah.
Interesting.
Mm-hmm.
Well, and then...
So yes, the answer is yes, you can do it. You just got to be ready for...
Brutal rates,
and hope that changes a couple years from now where you could refinance out of something like that.
And that's a straight rate? 30 years?
The 10, it's a 3 or 4 year loan, interest only. But yeah, you'd have to pay it off. You have to have an exit strategy in 3 or 4 years. I forget what it is. It's either a 3 or 4 year loan, but you'd have to have an exit strategy or be ready to pay it off in 3 or 4 years.
Would it be easier for citizens of Russia, Ukraine, Turkey, and Venezuela just to buy cash if they can and then do the cash out?
No. Not if they need the money soon. there's no
going to be the
difference.
season of the title in order for them to eliminate that interest-only
It
loan?
doesn't matter because you're still a citizen of that country, and you're still dealing with the same thing. So you're going to have the same loan to value or the same down payment regardless of how it plays out. You're just going to be paying closing costs twice, which, paying cash closing costs are minimal, but you might as well just do it at the time of purchase if you can, unless you think something's going to change residency-wise or something in 6 months to 12 months, then sure, potentially.
What if there's LLC and there's two members? One of them, it's a Russian citizen, and another one is American.
Yeah, you would have to be in your best interest to have the American as 100% owner of the LLC. Then you're in it to win it. You could always have like a.
Can you quickly update it? From just the one LLC was 100% U.S.
Are you talking about after getting financing?
Correct.
I mean, that's with anything after you get financing. I mean, most closing docs for lenders state that they don't want you to change title if they find out they could call your note due and payable. So I would never really suggest anything like that. Obviously, if you pay it off, then you can do whatever the hell you want. But I wouldn't suggest messing around with title after the fact because lenders could, in theory, come after you. Now, what are they going to do? I don't know, slap you on the wrist, tell you not do it again and change it back. I don't think that we're in the business to foreclose, but, you do sign closing docs with most lenders and or investors that where they don't want title changing after the fact. So I wouldn't necessarily suggest that.
Okay. So talking about the foreigners, same, a lot of people think that they need to fly in here to close.
Yeah, I mean, that's investor specific. I mean, a lot of times, they could do a remote closing, via Zoom or whatever the case may be, or even better, go to the embassy if there is one that's active, so to speak.
back over politics.
There might not be some active embassies in certain places, but most of the time they want you here because they want a valid passport and or visa or something. So most of the time they're going to want you here, but we have on occasion done remote closings in other countries, whether they go to the embassy or we allow a RON, which is remote online notaries. But I would just have them prepare to be here for the most part. I know in certain places it's probably not so easy, whether you're in the military or whatever the case may be. We have allowed exceptions because of that. So,
okay, I think let's wrap it up. So let's do last two. So one of them is there a lock of the rates only available for 30 days?
No, not at all. I mean, we work with a lot of builders, back to the builder thing, where they need extended locks because it takes 12, 18 months or whatever the case may be to close. So we have an extended lock policy. You can lock over a year if you wanted to. It's just you're going to pay a premium. And what I mean by that is you're going to pay a higher rate and potentially points up front as a deposit to hold that rate. What would be the
difference?
There's a whole chart. I mean, it's different. I mean, you can with standard financing to get the best rates. In reality, you could probably lock up to 60 days and get the best rates. 90 days doesn't change much. 120, sure, they're a little bit higher. So the longer you lock, the rate or the cost of the rate, meaning points, is always going to be higher. But you can absolutely lock more than 30 days. You'll get premium pricing if you lock 30 days. But like I said, with the builder stuff that we do, we have long-term locks where we say, all right, rates, this is an example, February 6th example. Rates are 5%, but you're buying a new build. They're not going to be done for 12 months. We can lock you in at 5.5. You pay 1 point to us up front as a deposit. Of course, if rates go down, we could potentially float you down to market when the time comes because 12 months is a long time. But if you want a secure rate, give us a deposit up front. We'll lock you at this, and we'll see what happens and play the game as such. So you can lock a lot longer than 30 days, that's for sure.
So scenario, let's say right now I'm getting somebody under contract and the delivery date, it's only Q4 2024. Can they lock a rate for a year and then put another lock on month 11, let's say?
No, I think
so
our
the
longest
contract date should match the lock date.
Yeah, I think our longest lock is 365 days. I'll look into it, but I'm 99% sure our longest lock is 365 days.
And then if the developer did not deliver within 365 days, then you screwed.
If you decide that you want a long-term lock. I mean, those particular situations...
Like they did not deliver the building yet.
Yeah, I mean, at the end of the day, if we're talking about a condo and a high rise and somebody wanting to lock that long and then it doesn't get done, I mean, I wouldn't play that game. With those types of clients, let's keep communication open. So when we look at our loan pipeline or whatnot, we know who's locked and who isn't. Everybody's locked. But if you have somebody who wants to get a loan commitment, before 2 years from now because they're buying at the Ritz-Carlton new development or something, and they're so concerned about rates, it's really us as a lender having a conversation with them and saying, let's look at this monthly, or let's keep communication open, or if you see, the world's going to end and rates are going to go through the roof, let's talk about this as time goes on because you're just so far out. It's not something you should be really concerned with at this second. Mm-hmm. I get it, but 9 times out of 10, a client isn't going to be that concerned when the building could take 2+ years, 3 years to build. It's really just keep communication open and let's see how this market plays out. Let's have this conversation again a year before it's built, 6 months before it's built. Now what's going on? So stuff like that, that's just too long to lock a rate, because locking rates, you're hedging funds, basically. It's like, you're at the casino or you're, hoping that, the rates don't go super low or super high. So it's a big hedge at the end of the day, and it costs lenders money if they just extend for years on end. It doesn't make any financial sense.
Good to know. Well, and talking about the interest rate, I think the last one, and we're going to wrap it up, it's that everyone's saying right now, interest is so high. Well, a week ago, we saw the change. Yeah. But interest is so high, I should wait till they go back to 3% and 4%.
Yeah, they're going to be waiting a long time. I'm going to be more gray by the time that happens. My crystal ball. I mean, it's anybody's guess. People who know more about the economics of this than I do, even though I pay attention a lot and I listen and I do a lot of research, they thought rates would be, call it in the 4s by now, and back down. The reality isn't that. Do I think the reality is going to be 2s and 3s in the next 10 years? I don't think so. I mean, those times are, sure, if there's another virus that hits or something like that.
Well, and we're still short on supply. So
yeah, I mean,
what would make them go to the 2-3 if we're still in a shortage?
Yeah, I mean, inflation is tapering off. Once, for once in the government's world, they actually might have done something that made sense, not for us in our industry, because they brought our industry to a screeching halt for like 6 months. But, raising the Fed rate, which isn't really tied to long-term mortgage rates, it seems like they might have tapered off inflation and they might have actually done something good economically for once in the last, who knows, however long that is. But again, another myth, so to speak, is, a lot of clients, consumers, individuals or whatnot, they think that the Fed rate is tied to long-term mortgage rates when it's really not. It has been a little bit, the last couple of years, so to speak. And usually mortgage rates have that built in 3 to 6 months in advance anyway, knowing that it's coming. But they're not directly tied whatsoever, and they haven't been historically. So, inflation goes down, calms down, eventually, hopefully goes away. Mortgage rates will come down with that. The whole employment and jobs claims and layoffs is a huge proponent of that too. Long-term rates are really an economic thing. So it all depends. I mean, there's big layoffs with big companies, and then all of a sudden employment's at its lowest in 50 years. So it's anybody's guess what's going to happen. Things are picking up on mortgage applications over the last 3 to 4 weeks, which is a good sign because people are kind of getting used to these rates in the 5s and 6s, which historically is kind of where they've been. So it's just, we're getting more qualified borrowers now for obvious reasons because they can afford those higher rates. The sticker shock of your payment increasing by $500 to $1,000 a month isn't easy for first-time home buyers, but they're starting to slowly come back off the fence. I actually, for how much I hate to say it, the government, I think, did a good thing because you can't keep going on and on about this craziness from here to eternity, even though we wanted it to. Everybody was buying a home, rates were low, the economy was going crazy, and at some point, either it comes to a crashing halt and the United States falls apart, or you have what they call a soft landing to kind of get things back to normalcy. a real market. And even now, real estate is still selling at record paces historically. I mean, it takes, usually back in the day, or not back in the day, like 2 years ago, it's taking, 8 to 12 months to sell a home.
Correct.
They're still selling in 60, 90 days, right? So they're still...
I think even less in the majority.
Yeah.
I mean, it's again, neighborhood
On average.
and a product.
On average, sure.
Thing.
Yeah.
But I just came from the conference in Las Vegas, and, I was talking to a lot of professionals from different states.
Mm-hmm.
And when I spoke with them like 2-3 months ago, they were really worried, right? They had a listing, they were sitting on the listings and all that. And right now, back to multiple offers, back to the line on open house. People are really like, once it got to the 6 and like right under 6, I feel like people were just able to like breathe out.
Yeah, they're able to swallow. I mean, rates are almost at 8%. And when people hear and see that on the news, or when they Google mortgage rates, they're like, forget this. I'm not doing it. So once they've come down, and they've come down, I don't know, it's been 45 to 60 days. The market has improved by about 100 basis points, which is about 1%, with 1 percentage point. But then again today, with the unemployment numbers, or this morning and over the weekend, they've gone up 30 basis points. So that's why I'm always like, when is this going to end, and when we're going to have normalcy? I mean, the barometer for where mortgage rates are going is the 10-year Treasury. So if you look at that, you can kind of see where mortgage rates might go or might have been 3 months ago, or over a certain weekly period of time. You can kind of see where the long-term rates are going, but that's even off too. So it's really anybody's guess what's going to happen. But I have a feeling they're going to come down a little bit more. I think by the end of summer, or at a minimum before the end of the year, we're going to see even better rates, and the market's going to pick up even more. But I think we're going to be in an up and down scenario for some time. Rates have just been going up and down and up and down. Sure, consistently the last 45 or 60 days, they've been slowly coming down, like I said, 100 basis points, but today they're up 30 basis points. So
but
it's anybody's
still,
guess.
It's not like, it's not a 4%, it's not an 8%. Like they're still going around that 6 number.
Yeah.
So does it worth to wait 6 months and paying rent, or like miss the summer season to sell?
Well, this is
order to
exactly
hope for a 0.5% less.
Yeah, and listen, what do they say? Marry the property, date the rate, or whatever, right?
That's the one.
So it's one of those things to where, if you're a client or a borrower, especially if you're a realtor with a very picky client that needs to look at 50 houses before they make a decision, or haven't even made one yet, you got to say, don't wait, because in 6 months when rates do go down, or when the ravage begins, or the craziness begins and everybody jumps off the fence, you're not going to be able to get the home that you like. Do it now. Jump off the fence now. Date the rate a little bit. Get the home that you love. There's not going to be multiple offers. You're not going to overpay. Buyer has leverage. How long is the buyer's leverage going to last? I would say at best for the rest of the year, but maybe towards summer, beginning of fourth quarter, I think the buyers are going to start jumping off the fence again, because everybody got that bug the last 2 years. I mean, everybody wanted to buy a property. Everybody you talked to, everybody wanted to buy a home. 50% of them couldn't get under contract because there was 50 offers. So those people are coming back slowly but surely. But they all still have that bug, and their lease is coming up, and what's going to happen? Well, then there's going to be multiple offers, and you just missed the boat. So it's best to find something now in this window, because this window won't last forever. And again, crystal ball, 6 months, 12 months, even if it's 24 months, there's a window here. Jump if you're a buyer at the end of the day.
Well,
That's
and
my
there was
opinion.
more than half, there was a survey, and like more than half of the people who bought during this whole crazy market, they were unhappy with the experience, because they either could not get the home which they like. A lot of
sure.
people had to sacrifice. A lot of people had to submit like 20, 30 and more offers in order to get just something.
They're not satisfied. It's a funky thing, because you say that because people have a perception too. Well, there's going to be less inventory because these people have such low rates on their homes, and they're not going to be able to get a home that they like because rates are twice as high. So it's an interesting thing, and what happened with this market, because you have that, and you have the scenario of, I'm not moving, I'm not listing. What's inventory going to look like in 6 to 12 months? Sure, there's more now, more than there was, of course, because there was none. But what's it going to look like, in 6 to 12 months? I think there's not going to be a ton of foreclosures, because that takes forever, going through the courts and everything. So what's this going to look like is going to be very interesting in the next 6 to 12 months for sure.
Well, and then I think we'll meet again in a 6-12 months and we'll see where it's going.
I can't wait.
Thank you, Tyler.
Thank you.